Hello everyone. Today we're talking about gold. In 2025, my public portfolio showed a net profit of 61.5%. But how was this profit achieved? What specific entry rules did I use? Where are the entry and management rules? Most importantly, how can you replicate the same result? In other words, today we'll break down the mechanics behind this result. Many of you are interested in a simple, stable strategy that allows you to earn money. Today we're talking about gold, but spoiler, this strategy works absolutely everywhere. Accordingly, today I'll show you the logic, how I find entry points, what types there are, how to manage trades, and how to exit. I'll show all of this with specific examples. We'll be using gold as our basis. So, friends, the very first thing we need to start our trading with is, of course, context. Before coming to the market, before starting any trading operations, we need to determine the market direction, set target guidelines, and identify possible critical zones, whether we're moving up or down, meaning where obstacles might appear, and where the price could potentially stop. And only after confirming the presence of a directional movement do we begin working on finding a specific entry setup. If we, for example, start looking for a specific trade, I always recommend working from a correction. Undoubtedly, the best entry point will always be during a correction. And to determine the target of the correction, we need to use a very simple algorithm. Highlight a completed cycle on the chart, plot volume zones on this section, and mark the largest zones as the targets for our correction. You can supplement this setup with a Fibonacci grid so that certain levels become more significant for us. Accordingly, here is an example of how this works in the real market. First, the initial correction stops at the first level of volume concentration. Then the second and third levels serve as the final ones from which the actual reversal occurs. If we're talking about finding an entry point, there are several styles here, and I tried to consider each of you, each subscriber, depending on your temperament, so that you can meet your needs and enter correctly without losing money. If you prefer to buy on pullbacks, you absolutely need to do it correctly. Don't average down, don't add to losing positions, but act at specific levels. This isn't my approach, I'll say that right away, because it makes you nervous. Even if you absolutely didn't make a single mistake with the trade, and even if you eventually end up making a lot of money, you will still inevitably have to deal with the lingering feeling that you might actually be wrong. But the potential in such trades is good, which is why I'm showing this to you. In front of you are two limit orders that we place for accumulation according to the Fibonacci levels. So we have 3 points, 38, 50, and 62%. What coincides with our concentration levels is the most important for us. The algorithm looks as follows. We set the entry point at the beginning of this accumulation, definitely the beginning, not the middle, not the end, but the beginning. We place the stop beyond the next accumulation at its end. Accordingly, the chart, the diagram, shows two examples of how this looks. And the second method, which I personally use, is safer. It's entering through the 3. This is the most popular method that I used in 2025 and which in fact brought me 61.5% profit on metals. And the algorithm for this entry is as follows. We wait for an actual breakout of the trend line for the corrective move and for it to hold above. That's the first arrow. Next, we wait for a consolidation, which most often forms as a 3. This is the second arrow, and we enter on the breakout. In this case, the stop is set behind the low of the local consolidation. And essentially, that's the whole trade. And often, such trades turn out to be not only safer, but also have a higher profit-to-risk ratio than all other similar scenarios. The third method, friends, is for you if you're a gambler, if you're a FOMO enthusiast, and you didn't wait for a correction. In other words, you see the market rising right here and now, and there are no corrective moves forming for entry, so we'll look at the third method. It allows for any market entry at any moment, provided the stop is set correctly. For this, we need to add the VSTOP indicator to the chart. Be sure to use only the 4-hour time frame. For it, the settings are a length of 20 and a multiplier of 3. Once you've entered the market, as soon as a candle closes beyond the VSTOP indicator, you close the trade. Minimal subjectivity, minimal overthinking. You simply enter and close the trade when the conditions are violated. That's really all we need to do. Notice how the crash that happened in February of 2026 was predicted using the VSTOP indicator. Here are examples of real trades from 2025. Let's go directly to the chart so you can see for yourself how this whole thing works. So, friends, here is a section in front of you. This is from September to basically February, from September 2025 to February 2026. So what does our work look like? We have a completed cycle, we overlay the volumes on it and highlight the most important zones. So here is the first pause and here is the second consolidation. We see that the price does not break through it. And here, in fact, is the consolidation, the third one that forms during the process. Here is the first entry. Then VSTOP comes into play, and when it is broken and the candle closes, the trade is closed. If the trade is closed, it doesn't mean we leave the market and that's it. No, we wait for the next consolidation and enter again. Next consolidation, we enter again. Next consolidation, we enter again. To the question, how many times can you enter? You can enter as many times as you want, as long as your previous trade is in profit. This will prevent you from accumulating that snowball effect, which, in the event of a crash, would wipe out all the profit you earned earlier. And then basically, it's very simple. As soon as our indicator breaks out, we close the trade. Next, we apply volume analysis to the existing zone and highlight the most important areas. We've roughly identified the correction level. The next consolidation, another consolidation, we enter trades, and accordingly, when the indicator breaks out, we close our position and exit the trade. So, friends, let's slowly start wrapping things up. What do we have as a result? Our trading strategy is as simple as possible. It consists of 5 steps, but they are important, and from a discipline standpoint, you must follow all 5. First, determine the context, that is the direction. Second, wait for a correction. Third, calculate the risk and the stop loss point. Fourth, enter the market correctly. And fifth, manage your position with a stop indicator. That's it. That's all you need to properly execute your trades. And here it's important to conclude that if you follow these steps with discipline, then not only in metals, but in any other assets, you'll be able to spot opportunities. If you need practice and more examples, join the Telegram channel below this video because I actually use these very methods in my own trading, share my ideas, and you can also profit from this. Friends, I've done my part. This was Dmitry Abramenko with you. That's all from me. Wishing everyone good luck and profitable trades. Bye.